Let's start off today's lecture by answering this question. What are the two differences between a period and a product cost? Cancer says product is directly linked to finished product. The product cost is directly linked to the finished product, okay? The finished product cost, okay? Product costs are directly traceable. Are all product costs directly traceable? No, not all of them, right? Which one is not directly traceable? Indirect labor, indirect materials, so and all of our other overhead, exactly. Those ones we cannot directly trace. Okay. Period costs are indirect costs, yes, and they are made of selling and admin costs. Very good. Very good. So that's a general idea, right? We have a general idea of the difference between those two costs already. Okay, perfect. Now, another thing I want to bring to your attention is expensed versus capitalized. The product cost is capitalized on the income statement. And what does that mean? Capitalized means basically that those costs are being absorbed in inventory. Inventory is shown on our balance sheet, right? A current asset is inventory. So back before when we first started financial accounting, you would have seen current assets. Under current assets, you would have seen cash, accounts receivable, inventory. Now, because we've learned three different types of inventory, now under current assets, you'll see cash, you'll see accounts receivable, you'll see work in process inventory, you'll see finished goods inventory, and you'll see the direct materials inventory. So those are the three types of inventories that we've learned about. And what happens is product costs, okay? The product costs are capitalized in inventory. But period costs, they are expensed as soon as they are incurred. So in 2021, if we have a marketing manager's salary in 2021, we're going to expense that right away on our income statement. But in the case of product costs, for example, direct material costs and direct labor costs and our manufacturing overhead costs, those three costs, in 2021, when we have incurred those costs, we are going to capitalize them in an asset. The only time we are going to expense, for example, when we have our finished goods, when are we going to expense? When are we going to recognize an expense? Once we have our finished goods inventory. Anybody knows when we're going to expense that? When will the costs in our finished goods inventory end up as an expense? What must we do? We have to sell. Very good. So once we sell the goods in inventory, then and only then are the product costs going to end up as cost of goods sold, which is the expense. So when you think of period costs, just think expensed right away. When you think of product costs, think capitalize first and then expense once sold. And then we talked about product costs already being a part of the production of the product. Anything that happens in the factory would be considered part of production costs. Direct materials, direct labor, and manufacturing overhead. Whereas period costs are costs that are separate from the actual production of the products, but we incur them after the product has been produced, or we can incur them during or before the product is produced, but it does not have anything to do with the actual production of the goods. For example, a manager's salary for the marketing department. Do we understand the differences now between period and product costs? There's a difference in production. Yes, that's the one we know, right? But then there's also a difference in terms of income statements where one is capitalized as an asset in inventory, and then when it's sold, it ends up on the income statement as an expense. But the period costs are expensed right away. So question is, can we remember the two different types of income statements that we've learned so far? So far, we've seen two different types of income statements. Can you remember what we saw? There was an income statement that we learned in financial accounting. And there was an income statement that we also learned, that it was the same income statement in week 4. And then we learned a different income statement in week 5 last week. Can you remember what those income statements were like and why they were different? Okay, so let me remind you. So we prepared an income statement before in week 4, and we also did it in financial accounting, okay? So what did that income statement look like? Well, we know the income statement starts with sales. Tarun says, cost of goods sold is equal to selling and general admin plus research and development. No, not quite. So we know in the in financial accounting and in week 4, we learned sales less our cost of goods sold. Now, Tarun was correct in terms of talking about our cost of goods sold, but how do we actually find it though? Cost of goods sold is equal to beginning inventory. Thank you, Ciara. And then we add purchases, but now we've learned about cost of goods manufactured in a manufacturing company. Yep. Gives us a cost of goods available for sale, less an ending inventory. Gives us a cost of goods sold. This gives us cost of goods available for sale. And then we deduct our ending inventory, ending finished goods. And this gives us a cost of goods sold. And once we get our cost of goods sold, we can deduct it from our sales. And that leaves us with what? Sales as cost of goods sold leaves us with a gross profit or gross margin. Very good. So once we find our gross margin, we can now deduct any operating expenses, which will be like selling and admin, right? Or period costs. And that is going to give us our operating income. Okay, so we learned this one. Now, last week, we learned a new one called the contribution margin income statement. And how was it different? We start again with our sales. And then what do we deduct? Variable costs, very good. So we have our variable. So we can deduct a cost of goods sold again, right? But that will involve a variable. Sorry, we can start with our beginning inventory, right? We add, this time, a variable cost of goods manufactured. This gives us a cost of goods available for sale, less ending inventory. This gives us our cost of goods sold. So beginning inventory, add cost of goods, oops. This gives us a cost of goods sold. We can also add to that our variable selling and admin expenses. It's gonna call it S&A. So this will give us our total variable costs. So once we have a total variable cost and we deduct that, what does that give us? Total variable cost deducted from our sales gives us what? A contribution margin. Very good. So our contribution margin, I hope everybody else is following this. And so we do the same thing where we're going to less our operating expenses, and this will include our selling and admin. Fixed only, right? Because we already did the variable ones up there. And it will also include our our fixed cost of goods manufactured. Leaving us with our operating income. I'm gonna call this total fixed cost. Okay, any questions here? This is very important for everybody to understand. That's why it took so much time typing this all out. The contribution margin income statement that we did last week versus the one that we did before. What is the difference that you see? A very basic difference. Anybody see a basic difference? Something about the variable components, yes. So what we see is that this one, the first one, doesn't separate. It puts the fixed and variable costs for manufacturing together, right? So this cost of goods manufactured here, or this cost of goods sold here is a mixture of fixed and variable costs. But then what we notice on this side is that for this one, it's only a variable cost of goods manufactured. They separate it. So this piece up there and this piece down here, it's separated. But for this one, they just put all of the cost of goods manufactured together right there. Can we see that difference? Great. So if you're giving this information right here, okay, direct materials, 13,000, direct labor, 15,000, variable overhead, 5,000, fixed overhead, 6,000, fixed selling expenses, variable selling expenses, administrative expenses. We produced 10,000 units and we sold 9,000 units, which means that there's 1,000 remaining in ending finished goods inventory. And we have a selling price of $8 per unit, okay? Are we able to use this information in order to come up with this? So I'm gonna give everybody about 5 to 10 minutes, right? The reason why I'm putting so much effort into this is because this is what's gonna really help you to understand when we move on. Take a picture of this slide with the information, okay? 5, 4, 3, 2, 1. Assuming that the pictures have been taken, right? I'm going to keep this slide up. I want you to use this information here to complete these different income statements. Everybody understand what they're expected to do? Okay. So try your best, 5 to 7 minutes. I'm not even gonna take the whole 10 minutes, 5 to 7 minutes. Try your best to see how you can plug in the information that you have into this income statement. Okay, so let's start. Is anyone confused? Or anyone finds this really easy? Like, I know how to do this. This makes sense. How are we feeling at this point? Mixed feelings. Okay, that's good. Because we haven't really started yet, right? What did you put for sales here? Sales amount is 8 times $8 times 9,000. We sold 9,000 units, right? So that's $72,000, okay? Thank you. Your beginning inventory, what did you get for that? Do we have a beginning inventory? No. Question did not give us a beginning inventory. Very good. Cost of goods manufactured. On this side, as we saw, the variable and the fixed come together. What did you get for that? What is your cost of goods manufactured? 68,000, okay? How did we get 68,000? What did you add? Anybody else has a different number, or did everyone get 68,000? 67,800, 80,000, okay? 57,000. What are you adding for your cost of goods manufactured? What are we supposed to be adding here for our product costs? Are we going to be adding variable selling and admin? Administrative expenses? Are we adding fixed selling expenses? What do we add? Okay, now I see 39,000, okay? Anybody else got 39,000? Rhea says, oops. Yes, Rhea probably found a mistake that she made. So 39,000, right? Because we are going to be adding direct materials of 13K plus direct labor of 15K plus variable overhead of 5K plus fixed overhead of 6K. That gives us a cost of goods available for sale of 39,000 because we don't have any beginning inventory. Are we good so far? Okay, now our ending inventory. This is the tricky part, our ending inventory. How do we find that? Now the question tells us that there's 1,000 remaining in ending inventory, 1,000 units of finished goods. But how much is that cost? What cost does that absorb? How would we find out the cost of 1,000 units of ending inventory? We only know the units, 1,000 units of ending inventory is left, but what's the cost? Effie says 20 cents. I get that 1,000, but I'm confused about how you found 20 cents. What are you multiplying by to get 20 cents? Just the variable selling expenses? So you think 20 cents per unit is just the variable selling expenses per unit? The cost of goods manufactured here includes all of these costs, 39,000. 1,000 times 8, where did we find 8? 8 sales price? Sales price wouldn't be our cost of ending inventory. That's how much we sell our inventory for, but it's not our cost. What is our cost? Our cost of goods manufactured tells us how much it costs to produce our product. It costs us $39,000. Exactly, very good. 39,000 divided by 10,000 units that we produced gives us $3.90 per unit. So we found out what to multiply the 1,000 by. We have to figure that out. Anyone clear? Everybody clear there? How we got ending inventory? 1,000 times 3.9? Good. So once we get that, that gives us, I think, 3,900. So 39,000 deduct 3,900 will give us 35,100. So our sales, that's our cost of goods sold, gives us a gross margin of 36,900. And then now we can deduct our operating expenses, right? This will be all of them, fixed and variable, fixed plus variable, right? So what are expenses that they give us in this question? Which expenses will go here? We have a fixed selling expense. We have a variable selling expense. We have an administrative expense. Fixed selling is 15,000. Variable selling expense is 20 cents per unit. So that will be 20 cents times what? 20 cents times what? Times 9,000. Very good. Not the 10,000 because it's a selling expense. So we're multiplying by what we sold. And then our administrative expense is a total of 12,000. So now we have our total expenses. Total selling and administrative expenses. And that is a total of 36,000. So our operating income is 900. All right. That's the regular income statement we learned before, where we join the fixed and the variable cost together. Now pay attention to this because there's a question down there where you're going to have to basically do this by yourself. Variable selling, did I put the wrong thing? Yes, you're correct, 1,800. Because I had to multiply it. Okay, thank you. 15,000 plus 1,800 plus 12,000, 28,800. And that gives me a profit of 8,100. Okay, fixed it. All good for this one? Yes, great. Now let's look at the income statement we learned last week, which is the contribution margin income statement. This one takes cost of goods manufactured and it separates the variable from the fixed. And this one says, let's calculate a contribution margin. So you know what? It says, I don't care if it's a selling or an administrative expense, as long as it's variable, put it up here. So we can have a total variable expense, a total variable cost, so that we can calculate our contribution margin. That's what it says. So let's go again. Our sales are 72,000, and pay attention to things that are going to be different. Beginning inventory is again 0. Add the variable cost of goods manufactured. The variable cost of goods manufactured. So cost of goods manufactured will be what? What will cost of goods manufactured include? 6,800? Was that 6,800 for cost of goods manufactured? Okay, our cost of goods manufactured is our product cost. What is our product cost made of? Direct materials plus direct labor plus manufacturing overhead. What are we going to put into our product cost to find a variable cost of goods manufactured? Somebody says the total is 34,800, but I want you to tell me how to calculate it. The first thing we're going to use is what? What's the first thing we need here? What's the first number are we going to add? Direct materials plus direct labor plus variable manufacturing overhead. That's it. Variable selling expenses is never going to go into your manufacturing costs, right? Variable selling expense will never go into your manufacturing costs. So direct materials again was 13K. So we use the same 13K, doesn't change. Then we also use 15K for direct labor. And then we're going to use a variable overhead of 5K for variable manufacturing overhead. So this gives us 33,000. Cost of goods available for sale is 33,000 because there's no beginning inventory. So then now we have to calculate what our ending inventory is going to be. Are we going to use the same unit that we've calculated down here, $3.90? Is it going to be the same one to find this ending inventory? Everyone's quiet because everybody's lost. I'm feeling like people are not following today. Lost. Okay, so can you tell me where you're lost instead of making me go on and then go over the cost of goods manufactured? Okay, so the cost of goods manufactured is your product cost. It's going to be made up of your direct materials, your direct labor, and your manufacturing overhead. Now, manufacturing overhead can be split into two pieces. It could be split into a variable manufacturing overhead and a fixed manufacturing overhead. In the first income statement we're working on here, we don't split the manufacturing overhead. We keep it together. So 13,000 is your direct materials plus your direct labor is 15,000 plus your manufacturing overhead, both variable and fixed, gives us a total cost of goods manufactured of 39,000. Now, what we realize is that's the total cost of manufacturing our finished goods. It's the total cost. But if we want to figure out how much did it cost us to manufacture only 1,000 of the goods, then we need to know the cost per unit. How much does one unit cost? We know the total is 39,000, but to find out how much it costs to make 1,000, we need to find out the cost of one. To find out the cost of one, we have $39,000 as the total cost of manufacturing divided by the number of units we produced in all. We produced 10,000 units in all. It means that $3.90 is how much it costs to produce one unit. So if we know how much it costs to produce one unit, we can find out how much it costs to produce 1,000. So that's why ending inventory is 1,000 units times $3.90, giving us a cost of our ending inventory is $3,900. Is that clear in the first bit? Okay, so what happens on this side is that we're separating out the cost of goods manufactured now. So that's why when we calculate the cost of goods manufactured, the $6,000 that's over here, which is the fixed bit, the fixed bit is not here. It's not in there, it's gone. We took it out because we only want the variable cost of goods manufactured. That's 33,000. Cost of goods available for sale is 33,000. Now, if we know the total of 33,000, how much is the cost of ending inventory, which has 1,000 left? 1,000 units in ending inventory. What's the cost of that? We're going to multiply the 1,000 by what? 33,000, Roxoliana, is divided by how much units you produce in all. Very good, 10,000, which is 3.3. So 1,000 times 3.3 is going to give us how much? 3,300. So 3,300 is the cost of our ending inventory. And so now we can figure out how much our cost of goods sold is. So 33,000 minus 3,300 gives us 29,700. 29,700 is our cost of goods sold. It's variable, okay? A variable cost of goods sold. That one was a mixed cost of goods sold or just the total. This one is just a variable cost of goods sold. And I could put variable there if it helps you to think about it, okay? And then we can add, this is where the selling and admin comes in. We have to separate the selling and admin from our manufacturing costs. That's why we didn't include it up here. We're gonna bring it down here and add it to the variable cost of goods sold to get a total variable cost. So the variable selling expense would be 20 cents times the 9,000, which is 1,800, right? So when we add those up together, we get a total variable cost of 29,700 plus 1,800, which is 31,500. 72,000 times minus our 31,500 is going to give us what? What is that called? 72,000 of sales less our total variable cost of 31,500 is 40,500, and that is our contribution margin. That's how much we have to contribute to our fixed costs. and still hopefully leave us with a profit. So our selling and admin fixed costs were how much? If we combine them together, it will be 15,000 plus 12,000, selling and admin together fixed. So that's our 27,000. And our fixed cost of goods manufactured, remember, we did not include that up here like we did over here because we're separating the variable from the fixed. So our fixed manufacturing overhead, according to this, is how much? How much is fixed overhead? The 6,000 that we didn't put in before. So 27,000 plus 6,000 tells us our total fixed cost, which is 33,000. So once we deduct contribution margin minus our total fixed cost is going to leave us with operating income. And it's a good thing that we have enough to show to cover our fixed costs and still get receive a profit of 7,500. Great. So this is the difference between the old one, that was the old income statement that we learned, where we put all of the cost of goods manufactured just into one number, and the contribution margin one, which says the cost of goods sold needs to be separate. Cost of goods manufactured has to have variable so we can get a contribution margin, and then we'll deal with the fixed stuff afterwards. Okay. Are we clearer now with this, now that I explained it again? Are we clearer now? Effie is okay now, okay? Alyssa feels good, all right? And it's just early in the game, so now that we have this foundation, hopefully things will go a lot faster as we move on from here, okay? Anybody has any questions before I move on to the next slide? Samian, are you okay? Jana, are you okay? Or Jana? Tharoon? Okay, great. So we're moving on. Full costing versus variable costing. So what we just did there, the old income statement is called a full or absorption costing, which means we're just keeping the full cost of goods manufactured. We're not separating the variable from the fixed, it's full. The variable costing one is like the contribution margin income statement from last week, where we said we're separating the cost of goods manufactured. We're going to put the variable ones at the top, get our contribution margin, and then we're going to deduct all of our fixed costs together at the end, okay? The full costing or absorption costing is used under GAAP, so that's essential. We need that if you're under GAAP. But then for variable costing, it's not mandatory. We're just using it for internal company reports. Okay, so this is the difference that we just discussed it. Product cost is calculated using direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead, whereas the product cost under variable costing is only calculated using the direct materials, direct labor, and the variable manufacturing overhead only. That's all you need for the product cost under the variable costing method. And then, as we learned in the beginning, fixed manufacturing overhead, okay, is capitalized, or this product cost, all of it is capitalized in inventory, only expensed when products are sold in cost of goods sold. But under the variable costing method, because we put the fixed manufacturing overhead down there, you see how we have it at the bottom there, down where we have the operating expenses? What's happening to fixed manufacturing overhead? Up here, we're putting it as, we're capitalizing it at the top here. But in the variable income statement, we have it at the bottom as an expense. So what do we notice? We notice that under the variable costing, the fixed manufacturing overhead is expensed in this period, okay? Expensed in this period. Variable costing, all fixed costs are expensed in the current period. And the absorption costing, it capitalizes all of the overhead, all of the direct materials, all of direct labor, and only expense when it's sold. Variable costing says, I don't care when it's sold, we're just gonna expense the fixed manufacturing overhead right away. Okay, so that's gonna really help to reduce our operating income. So again, the difference between absorption costing and the variable costing is what? What's the major difference between both of them? What is the major difference between absorption costing and variable costing? What is the thing that causes the major difference? If you understood what we did before, you should be able to answer that question. Fixed manufacturing overhead, thank you. Fixed manufacturing overhead is included here in the product cost, but in variable costing, it's not included in the product cost. It's expense down here at the bottom as an operating expense. Everybody gets that. Okay. Yes, no, nobody is just, okay. Toby gets it. Okay, good. So what is the total product cost for the company under variable costing? So look at this question here. You're gonna have an opportunity now to calculate the variable cost, okay, in this company. So please go ahead and drop your figures in the chat. I think many of you understand it now. We spent a lot of time, but it was for a good cause. What is the variable costing product cost? What is the product cost under variable costing? 69,400, correct. Good. So we're just adding up direct materials plus direct labor plus variable manufacturing overhead. Okay? Direct materials plus direct labor plus variable manufacturing overhead. So that's 14,400 plus 25,600 plus 29,400 equals 69,400. Now, what is the product cost if it was for absorption or full costing now? What's the product cost? 81,400, 81, okay, so everybody's getting the same thing. So again, 14,400 plus, again, the same, 25,600 plus, again, the same, the 29,400, but we also need to add now the different thing. And remember, the different thing is the fixed manufacturing overhead. So we add the fixed manufacturing overhead in 12,000, and I'm guessing everybody is correct. If everybody is correct, then the answer is going to be equal to $81,400. Good. What if I said to you, what is the product cost here? The cost per unit. And imagine we produced 1,000 units. So what is the product cost per unit under variable costing? What will we do if we produce 10,000 units and I want to know the cost per unit under variable costing? We are going to have 69.4 or 6.94, which one? We produced 1,000 units. I think 69.4 is correct, okay? If it's 81,400 and we produced 10,000 units, what is our cost, product cost per unit under absorption costing or full costing? When I say cost per unit, I mean how much is for one of the goods that I made? All of the goods I made and I finished making cost 81,400. How much is for one if I made 10,000 of them? $8.14. Everybody understands that, right? Pretty straightforward, that part. Great. So let's keep going. So we have absorption costing versus variable costing. Variable is equal to direct materials plus direct labor plus variable manufacturing overhead. Full absorption or absorption costing includes the same thing, but we add the fixed manufacturing overhead. So Before I asked you, imagine that we produced 10,000 units. How would we calculate our cost per unit? So this is the formula here, the total product cost divided by the total units produced. Okay, the total product cost divided by the total units produced. So let's go to chapter 8, and you're going to do question 817. This is the part I said you're going to have to pay attention because you're going to have your own chance to work on it. 817. Okay, 817, please work on part A and B. Okay, so set it up the way that I set it up, where I have on one side I have the absorption costing, on the other side I have the variable costing, so you can really see how they're different and how they are the same. Would you like me to put up a different slide that might help you to fill this in? The slide I did before, maybe? Maybe take a picture of this one, and then I can put it back to the slide from before where we did the other example. And so you can use that to come up with your answer, okay? So if you don't have the textbook as yet, take a picture of this page. I'm gonna go back in 5 seconds. 5, 4, 3, 2, 1, 0. So take some time to work through it. Trust me, it's gonna really help, especially for your second midterm. The time is 8:11. We can take it up at 8:20. So don't just wait for me to do it. I want you to actually practice it as well. It's gonna really help you to make mistakes, and then you make the mistakes here and you won't make that mistake when you get to the exam. Yeah, so you calculate the variable. The first thing you're gonna do, yes, is calculate your variable cost and your absorption cost. And then you're gonna create these income statements here, okay? So did you take a picture already of the question, or do you have the book? You can turn to that. Okay, great. So I'm just leaving this slide up. You can use this as a guide to answer your question. Anybody has any questions while they're working on it? Any roadblocks that anyone ran into I can clear up? We just have about 3 more minutes before we take it up. Okay. So what do we get for sales? What's our sales amount? All right, so it was a $90 times 10,000. Is it 10,000? No, 8,500. That's how much we sold. So 765,000. I'm just going with what Shen Shu said because I didn't calculate it myself. Anybody agrees with that? 765,000? Great. So our cost of goods sold includes our beginning inventory. Do we have beginning inventory in this question? Beginning inventory? No? Okay. Cost of goods manufactured. See, I love to see the answers. That means we're following. Cost of goods manufactured in this case would be, they give us a variable manufacturing cost, fixed manufacturing $100,000, variable selling and admin 9, fixed selling and admin, selling price, units produced, units sold. So they give us a variable and a fixed manufacturing cost. I see 140,000. I see 500,000. Which is it? What is the cost of goods manufactured under the? Let's be official now, okay? Let's call this the absorption or full costing method. Okay, we don't have to call it the one from last week anymore. Variable costing. 140,000, 500,000. Friends, what is the cost of goods manufactured? What are you adding together? How did you get 140,000? 40 times what? 40 times 10, okay. plus the 100,000. Okay, so 140,000. So what is your cost per unit? What is your cost per unit? They give us 100,000 divided by 10,000 shades is 10. So we got 40 plus 10. That's our cost per unit, right? Is that our cost per unit? 40 plus 10. What did you guys get? I only see two answers, 500,000 and 140,000. Which one is correct? How is cost of goods manufactured 140,000? I don't know. You tell me. What did you get? 500,000. How did you get 500,000? Can you explain to us how we get 500,000 so we can understand it? Okay, so 40 times 10,000 is 400,000, okay? Plus 100,000. Okay. Okay, so two people have the same thing. Now I'm seeing answers. Now I'm seeing answers. Thank you. Right? So not 40 plus 100,000, okay? 40 times 10,000 is what's going to tell us how much it is for the variable manufacturing cost, because remember 40 is a per unit amount. That's just for one unit. Okay, so another way we can do that is we know that the $40 is the per unit for variable manufacturing. 10 is the one for fixed manufacturing. When you put that together, it's $50. Okay, $50 times 10,000 units is 500,000. That's what I need. I need discussion, right? So if somebody says, okay, this is 140,000, that doesn't make sense. Why doesn't it make sense? Let's fix it. Okay, are we good with this? So that means the cost of goods sold, because we don't have any beginning inventory, is 500,000. And our ending inventory will be what? Do we have any ending inventory? We produced 10,000, we sold 8,500. What's our ending inventory? 1,500, exactly. 1,500 units we have, but what's the value? What's the cost of those 1,500 units? We're gonna have to multiply that by a cost per unit. Did we find our cost per unit? It is 50, exactly. So 1,500 times 50 is 75,000. That's how much is in our ending inventory. That's the cost. So 500,000 less 75,000 will give us our cost of goods sold, which is $425,000. Right? And our 425,000, once we deduct that from our revenues, we get our gross margin of 340,000. And then now we can deduct our operating expenses. Which expenses do we have to deduct? Our period costs. Remember all of our period costs. We have variable selling and admin, fixed selling and admin. So fixed selling and admin. Fixed selling and admin is how much? What's our operating cost? Fixed selling and admin is how much? 250,000. And our variable selling and admin is $9 per shade. So that's 9 times 8,500, right? Remember, our period costs are not about what we produce. Period costs is about what we sell. So that's 76,500. So 250,000 plus 76,500 is $326,000. And therefore, that means our operating income is $13,500. Anybody got that or almost got that? Almost is good enough for me. Cost of goods manufactured numbers, where did they come from? So, good question. Okay, let me put up the question again so I can see it. So we have a variable manufacturing cost of $40 per unit. And then we have a fixed manufacturing cost of $100,000. So we're gonna say $100,000, but we wanna know how much is that per unit. 100,000 divided by how much did we produce? 10,000 units, which will give us $10. So $40 plus $10 is $50 per unit. Okay, $50 times 10,000 units, that's how much we produced, is going to leave us with 500,000. Claire? Great. So now our variable costing comes in. It's the same thing for your sales, 765,000. Beginning inventory is 0. The cost of goods manufactured, is this going to stay the same? No. Cost of goods manufactured is going to change because the cost per unit is now only what? Now only the cost per unit is? What's the new cost per unit for the product cost per unit? It's just a variable of $40, exactly. So $40 times 10,000 is going to give us a total of 400,000. That's the new cost of goods manufactured. So our cost of goods available for sale is 400,000, and our ending inventory will also change. We still have 1,500 left back, but our cost per unit is different again, and our cost per unit is 40. So the cost of the goods in inventory is going to be 1,500 times 40, which is 60,000. And this will give us a variable cost of goods sold of 340,000. Good so far, everyone? Yes? No? Everybody okay so far? Ria is good. Roxoliana is good. SNM, Tarun, good. Lots of people are good. Then we're going to add, again, remember in this one, we're trying to find the contribution margin. So we need total variable cost. So what's the other variable cost there? The other variable cost is the variable selling and admin. We're gonna put it in at the top this time, right? Because we need a contribution margin. Total variable cost is 340,000 plus 76,500, which is 416,500. Okay, so our contribution margin is, what's our contribution margin now? $348,500. Once we have a contribution margin, we can deduct all of our fixed costs now. So that's our fixed selling and admin and our fixed cost of goods manufactured. So what is our fixed selling and admin? We have it over there of 250,000. Is it 250,000? Yeah, 250,000. And also our fixed cost of goods manufactured, which is, what is our fixed cost of goods manufactured again? Who can tell me? 100,000. Good. So our total fixed cost is 350,000, and our operating income, do we have an operating income? What do we have? Was our contribution margin able to cover our fixed costs and give us a profit? No, we have an operating loss, or net loss of 1,500. How do we feel about this topic? How do we feel? So far, we're okay with the difference between the two? More comfortable with the variable one than the full one, okay? But as long as you understand what you need to do for variable, then, and you figure out that the fixed manufacturing overhead is the only thing that's different, then you should be fine, okay? So when you're doing absorption costing, the first thing you do is you calculate the absorption product cost per unit, and we know how. Direct materials, direct labor, variable manufacturing overhead plus fixed manufacturing overhead. Then, well, once we have the product cost per unit, remember you have to divide that. If they didn't give you all of them per unit, you have to divide by the total number of units you produce to find the per unit amount. Well, feel free to use this one. So when you get the slide, you can use these, okay? Maybe just copy and paste it to Excel or something. And then step 2, use the product cost per unit to create the absorption income statement, which we know how to do. We can take our product cost per unit and we know how to make an absorption income statement. Variable costing, the same thing. You calculate your variable product cost per unit. We know how to do that. And then we're going to use our variable cost per unit to create a variable income statement, okay? Remember, the contribution income statement separates all variable costs from the fixed costs, okay? All variable costs, so it doesn't matter if it's period or product. As long as it's variable, it's going to be separate from the fixed costs, okay? So now I had chapter 8, question 824 for you. I wonder if I want you to go through this now. Okay, let's check to see chapter 824, calculate the total manufacturing. Yeah, go ahead. Let's do question 824. So people who didn't get it those couple of times can get it now. Total manufacturing cost, what is the difference? So we have this information, the wood used, obviously we know that's direct materials. Nails, considered insignificant and the variable expense. Can anybody remember what I said an insignificant cost goes under? Where does it go if it's immaterial, if it's insignificant? We put it under, do we use it, do we include it in our direct materials? No, it's manufacturing overhead. And the question says variable manufacturing overhead, very good. Then we have our direct labor, we have utilities for the factory, and we know that utilities for the factory is going to be manufacturing overhead as well. But if you look here, there's a fixed portion, which is 1,500 each month. And then there's also a variable portion, okay? Fixed and a variable portion. So this part is the fixed overhead and this part is the variable manufacturing overhead. And then we also have the rent expense for the factory for the year of 21,400. I'm actually going to skip this question. I'm going to let you practice this on your own, but I want to point something out. Right here says the factory rent for the year. Right here says factory utilities for the factory, $1,500 each month. So you know you're going to have to do some calculating in there in order for you to find out how much it is for the year if you're going to be calculating your product cost for that period, okay? So I'm going to leave this one for you to do as your homework, just so I can see, you can see for yourself that you're practicing what we've just learned before. This part is just, it's easier because you're not expected to do the actual income statement, but just to understand that there is a variable, how to calculate the manufacturing cost under the variable costing approach and how to do it under the absorption costing approach. All right, So there's this part here. Okay, this part here is it's very abstract. Okay, it's very abstract. And what I'm going to suggest, just because it's so abstract, we've been going for a while with some heavy information. I want us to take a break right now, get some water, get us a quick snack, because when we come back, I'm going to try to explain this part for you. Okay, so go ahead, you can take a quick break and we will be back at 8:50. Okay, quick break, be back at 8:50. Okay, is everybody able to see the screen if it's this size? Just because I want to be able to type in it. Can you see, can you see it? Okay, great. All right, so let's get into this. This part is the abstract part. Okay, I'm gonna try my best to be as detailed as possible here. So please, your full attention at this part. Okay, this is a common exam question, very common. Understanding the effect, okay, that changes in production level and sales level have on net income under absorption costing and variable costing. Let's get into it. This I got from your textbook, 2021, 2022, and 2023. In 2021, beginning inventory is 0 and ending inventory is 0. Because we produced 10 and we sold 10. In 2022, if ending inventory is 2021 is 0, what is beginning inventory in 2022? If ending inventory is 0 in 2021, what is beginning inventory in 2022? 0, very good. But in 2022, we produced 10 and we only sold 8. So our ending inventory was 2. If in 2022 our ending inventory, is 2, what is our beginning inventory in 2023? 2. 2022, we have an ending inventory of 2. That 2 units is, we're not gonna throw them away, no? Those 2 units of drones, those 2 drones, we're gonna move them over into 2023 and try to sell them in 2023. They become the beginning inventory in 2023, beginning finished goods inventory. So in 2023, we produced 10 and we sold 12. So what is our ending inventory in 2023? How can we produce 10 and sell 12? Where did we get the other 2 from? How did we produce 10 and sell 12? Right, we added it to the beginning inventory. Beginning inventory per cost of goods manufactured gives us a cost of goods available to sell. So we have 12 drones available to sell. We sold them all. Our ending inventory is 0. If there is a 2024, our beginning inventory will be 0. Good, we get that, perfect. Now let's look at this, okay? I have 2 income statements here based on the information in this extract. Sales is 4 million because they're expensive, right? $400,000 for 1 drone. And we sold how many drones? We sold how many? 10. So that's $4 million of sales. Less our cost of goods sold. We know beginning inventory is 0, and our cost of goods manufactured under absorption costing includes both direct materials, direct labor, plus all of our manufacturing overhead, fixed and variable. So what is our cost of goods manufactured? $240,000 per drone. And then fixed manufacturing costs for the year. So what is our total cost of goods manufactured? If it's $240,000 per drone, how much is it for the year? If each drone costs $240,000 in variable manufacturing costs, How much is it for the whole year? That's good, 2.4 million, exactly. So then when we add that to the 240,000, so my number is wrong then. Is my number wrong? 240,000 times 2,400,000 plus 600,000. No, my number is correct. Okay, so 3 million is a cost of goods manufactured. Makes sense? Good. Cost of goods available for sale is 3 million, less ending inventory is 0. Cost of goods sold is 3 million. Gross profit is 1 million. Variable and selling 130,000. Operating income is 870,000. We go over to the variable costing. 4 million is our sales, and our cost of goods manufactured is the same. How come our cost of goods manufactured is the same as in absorption costing when we're supposed to only be using our variable? Something wrong? Is our variable costing supposed to be the same here? Cost of goods manufactured, is it the same under variable costing approach? Yes, I know we produce the same 10, but is it supposed to be the same cost? What's wrong here? $240,000 times 10 only, okay? So then our total cost of goods manufactured is 2,400,000, correct? Everybody agrees with this change? Yes? Good. So cost of goods available for sale is 2,400,000, 1, 2, 3, less ending inventory is 0, gives us a cost of goods sold of 2,400,000, 1, 2, 3. So we have a gross profit now of what's 4 million minus 2,400,000. 1,600,000. Did I do something wrong? Nobody is stopping me. Nobody is saying that, Samik, you're going wrong. What am I doing wrong here? I'm doing the variable costing approach. What's wrong? This is the variable costing approach. Am I supposed to end up with a gross profit in the variable costing one? No, I'm supposed to end up with a contribution margin. How come nobody stopped me? So we know that our cost of goods is 2,400,000. We also need to figure out what our variable selling and admin. Oh, it's up here already. I'm just gonna copy and paste it. We gotta bring this one up. Remember, right? We said we gotta bring it up. So what's our total variable cost? 2,450,000. And this, we're gonna deduct this to give us what? What do we come up with? Is it a gross profit? Contribution margin, CM, thank you. So if we found our contribution margin, 4 million minus 2,450,000, we get 1,550,000. And then we have to deduct our fixed selling and admin of 80,000. And what do we come up with? What's the total? Did I do something wrong? I intentionally put this the template wrong so that people can see that, you know, it's not going to look the same as the absorption costing. There are some changes, right? So is everything okay or is something wrong? Fixed cost of goods manufactured. Okay, so you're saying that we need to add in our fixed cost of goods manufactured. Okay, all right. Oops. Fixed cost of goods manufactured. How much is that? $600,000. So then I guess we're going to be deducting $680,000 then instead of just 80,000. Okay, so our total cost is 680,000 fixed cost. All right. So then at this point, what is our operating income then? 870,000. Do we notice that it ended up being the same? So whenever you have zero ending inventory, your operating income for absorption and variable costing will be exactly the same. Whenever you have zero ending inventory, it's going to be the same. Okay? So write that down. Whenever you have zero ending inventory, your operating income for absorption costing and variable costing is going to be the same. This is 2021. And then let's imagine that in 2022, we decided that, well, we didn't decide that there is now ending inventory. So how much ending inventory is it in 2022? How much ending inventory is there in 2022? 2 units. So right here has to change, right? We're going to put something there. How much? 800,000, okay? We're gonna put 800,000 there. Now, what is this 800,000 doing? Where did you get 800,000 from? You multiply 2 by what? 2 times the selling price per unit? Guys, think about the fact that we have, I'm gonna erase this now. We have ending inventory. What is the cost of our ending inventory? How do we find it? We know we have 2 units, but we gotta multiply that by something. What do we multiply it by? 8? 2 times 8, so 16? We did this before. Somebody said 2 times 400,000. So we're multiplying it by the selling price for ending inventory. The cost of our ending inventory is the selling price of our ending inventory. That's different. Think again. 840,000. Correct. Well, kind of correct. We need the cost per unit. So 240,000 is the cost per drone for variable, but what's the cost per drone for fixed? 600,000 divided by 10 is equal to 60,000. So the answer is 300,000 exactly. So 2 times 300,000 is equal to 600,000 is an ending inventory. Very good. So we got 600,000 in ending inventory. So our cost of goods sold is now 2,400,000. And our gross profit is now 1,600,000. Look at what just happened to our cost of goods sold. Before, our cost of goods sold is 3 million. Now that we have ending inventory, our cost of goods sold is how much? 2,400,000. Our cost of goods sold went up or down? Drop in the chat what you think. Did our cost of goods sold go up or down? First it was 3 million, now it's 2,400,000. It's going down. Good. So when our cost of goods sold goes down, what happens to our gross profit? If this cost is less, what is happening to our gross profit? It's more, exactly. Our gross profit is more. So when we deduct our variable and fixed expenses, what's going to happen to our operating income? Is that going to make our net income more or less? Higher. Anybody else sees that it's going to get higher? It was 870,000. Our cost of goods sold is less. Our profit, our gross profit is more. So our operating income is also going to be more. It's going to be 1,470,000 because we have ending inventory. Now let's see what's going to happen over here with our variable costs. We have inventory, ending inventory, so that has to change. How much is our ending inventory? Our ending inventory is equal to 2 times what? Is it 2 times the same one as absorption, or is it different? 2 times, how much is ending inventory under variable costing for this question? Drop it in the chat. 2 units in ending inventory times 240,000 is 480,000. Good. So 480,000, right? So did our cost of, sorry, our cost of goods sold is now going to be what? 1,920,000? Is that what everybody else got? Plus our variable selling and admin, which is 50,000, gives us 1,970,000. Our contribution net margin is now 2,030,000. So let's go back up. Up here, without ending inventory, our cost of goods sold is 2,400,000. What happened to our cost of goods sold down here? Is it more or less? Is our cost of goods sold more or less? It's less, okay. So with our variable selling and admin, we have our total variable cost and a contribution margin of 2,030,000. And once we deduct our fixed selling and admin, or a fixed cost of goods manufactured, how much are we going to get now for our operating income? Minus 680,000, 1,350,000. Which one has the higher operating income? Variable costing or absorption costing? Which one is higher? Who has the higher operating income or net income? Absorption, very good. Absorption is higher. So when there is ending inventory, absorption costing's operating income or net income will be higher than the variable costing one. So what will happen, and I'm not going to do it for the interest of time, what will happen, do you think, if instead of there be an ending for us to have ending inventory, we need to produce more than we sold. If we sold more than we produced, which of these do you think will have the higher income? The variable one. Okay, just the opposite. Does that make sense? If you don't have any inventory, you produce and then you sell the same, then your operating incomes are the same for both income statements. If you end up producing more than you sold and you have an ending inventory, your absorption costing, operating, or net income will be higher than your variable costing income. If you end up selling more than you produced, then your variable costing income statement will be more than your full or absorption costing one. And this is what you're going to see in this table right here. Okay? It's all because of ending inventory. And very quickly, what happens with ending inventory, if we notice, is that this $600,000 here, where is it going to go? Where is it going to go next? Where is this 600,000 going to go next? Anybody knows? Next year's beginning inventory, exactly. So what we're doing is basically we are taking some of the cost, which is the fixed manufacturing overhead, because that's the only difference here. Fixed manufacturing overhead is in there. We're taking that bit of the cost and we're going to be pushing it into the next year. But in variable costing, this fixed manufacturing 600,000 there, it doesn't get pushed into the next year. We're expensing it right now. This ending inventory reduces our cost because instead of accounting for it now, we're going to push it into the next year. It becomes the beginning inventory of the next year. But the variable costing one says, expense it right now. That is why when there's ending inventory, the operating income on the absorption costing will be more because we're pushing some of our costs next period. Variable costing says, no, our fixed manufacturing overhead, we're going to expense it right now. Does that make sense? And then there's this table here that really just summarizes that. If it's equal, it's the same income. If you produce more than you sold, absorption is more. If you produce less than you sold, variable costing is more. Just one person is good. You can rewatch the lecture again and you can get another taste of the information. So the rest of this chapter is conceptual. We've gotten through all of the quantitative, abstract, kind of confusing parts. What I'm going to ask you to do on your own for this chapter is to look over the advantages of variable costing versus absorption costing for decision making. And these slides are taken from the slides from your Wiley Plus that's already on your e-class. Okay. And right here, I gave you a summary of the things that are in an absorption costing income statement and a variable costing income statement that you can use while you're studying. And now we're going to go very briefly for the next half hour into chapter 9 on pricing. Okay, chapter 9 on pricing. Give me 1 second, I have to let my dog in the house. So the learning objectives for this chapter, we're gonna need to be able to calculate a target cost. We need to figure out how to calculate a target selling price using total cost plus pricing, calculate a target selling price using absorption cost plus pricing, and calculate a target selling price using variable cost plus pricing. So when you're studying for this chapter, I would suggest using these 4 points and making sure that you can answer questions that deal with these 4 points, okay? So We know, all of us know, that there are many different factors in the world that affect a price of a product, okay? But we also realize that we want the price of our product to cover the cost, but not just cover the cost, but also give us a profit. So what we need to be able to do as managers is we have to have an understanding of our price objectives. We need to know about demand, so supply and demand. We have to look at the environment and how different political reactions can affect prices, or different patents or copyright protections on different products. And we have to also do some cost consideration, which is mostly what we're going to be really looking at in this course. So cost considerations. And we're looking at both the fixed and variable costs. Okay. So companies that just accept the price in a competitive market are known as price takers. And the market will set the price when a product cannot be easily differentiated. So if you have a very unique product, then you can set the price for that product. But if your product is very general and there's nothing specific about it, then the market is going to set the price for that product. Okay, and I literally just said this. A company can set the price when a product is specially made or one of a kind. Okay, so if you have a niche where you're the only one or very few people are producing a specific product, then you are able to go ahead and set your price. Okay. So target costing. So basically what this is, that you know the cost of your product, you know how much your product, you know how much your product costs, or you know how much you want to sell your product for. You know, you have an idea of what you want the price to be, or what the competitors have set in the market. What is the price out there? And as the company or the business, you're going to have to basically fall in line. So how much should I cost? How much should my product cost, so that I'm able to make a profit from the price that is already out there? Okay, a price is already set for your product. Your product isn't anything special. It's a very basic product. Everybody has it. You're basically going to have to go with what the market is going to be setting the price as, based on supply and demand. And so what you're going to have to do as the business is, I'm going to have to make sure that I can achieve a certain cost so that I can achieve my desired profit. The formula for that is the market price minus your desired profit will give you your target cost. Okay. The market price minus your desired profit will give you a target cost. So with that being said, can we jump into chapter 9, exercise 917? Chapter 9, exercise 917. Going to give us a really quick practice on target costing. So Lassic Look produces and sells high-end golf equipment. The company has recently been involved in developing various types of laser guns to measure distances on the golf course. The potential market for one smaller laser gun, the Little Lassic, appears to be very large. Okay, there's a large market. Because of competition, Lassic Look does not believe that it can charge more than $90 for Little Lassic. At the price Lassic Look believes it can sell 100,000 laser guns, and they will cost, Little Lassic will cost $8 million to manufacture, and the company wants an ROI of 20%. So determine the target cost for Little Lassic. Determine the target cost. Right, so knowing that your equation for your target cost is market price minus desired profit, I'm going to give you 2 minutes just to look at this question. See if you can come up with part A said, sorry, determine the target cost for Little Lassie. How much do you think it's going to cost? Any answers? 74. Somebody thinks it's 74. Any other answers? It's a good answer. Someone has 96. Okay, for the interest of time, I don't have enough time to type everything out like I was for chapter 8. So I'm going to pull it up for us to check. You can use the next couple of seconds while I do this to drop more answers in the chat. So the answer is $74. So the person who said 74, Roxoliana, you are correct. Okay, so what we realize is that because we know the target cost is the price minus our desired profit, we need to find out what our desired profit is, because they gave us the price, it was $90. And they told us the return on investment needs to be 20%. And we know we invested $8 million because the question said so. So that's $1,600,000. But how much is the return? How much is that per unit? We divide that by the 100,000 that we can sell. So that's $16. So our desired profit per unit is $16. 90 minus 16 is equal to 74. Do we understand that part, that one? Yes, okay. So in a highly competitive market, as we said before, the price is largely determined by supply and demand. So it's very important that we are able to control our costs so that we can earn a profit, okay? We need to be able to control our costs so we can earn a profit. So that's what we were doing there. We knew what the price was that is set by the market. We knew what our profit, what we wanted our profit to be. So we were able to find out a target cost. And we will use that cost when we're managing our business to ensure that we can stay within that cost and to ensure that we can make our desired profit. Where did the 90 come from? 90. 90 was a selling price, so that wasn't the question. So it says here that $90 is how much we can charge. So that's the selling price. Does that help? Is that clear? It wasn't the, yeah? Okay, perfect, good. Let's move on. So everybody understands how we're finding a target cost? How can we do that? I think that one was pretty straightforward. Okay, now a total cost plus pricing. So what's going to happen is that we have a cost and we have to decide how much should we add to that cost in order to come up with our price. So we have a cost per unit. How much should we add to that cost in order for us to come up with a price? That price obviously is going to help us to come up with our desired profit in the end, right? So this is a situation where there's not a lot of competition and you are able to set your own price, okay? So this price is usually based on your product cost, right? So if you find your product cost, which we learned how to find, you're able to now use that product cost and you can come up with how much you want to add to that, kind of like a markup, so that you can come up with a good price. So it says here, add a markup based on desired operating income or return on investment. And this is the formula. So we know our cost, right? We have a markup percentage. We multiply the markup percentage by our cost, add it to the cost, and that will tell us our target selling price. This is pretty straightforward, and we can see this in question 918. So can you please go to question, I don't think I included it, no. So go to question 19 in your textbook. It's right at the bottom here. So it's about Mucky Duck, makes swimsuits and sells them directly to retailers. Lucky Duck has a variety of suits. It does not make the all body suit used by highly skilled swimmers. The market research department believes that a strong market exists for this type of suit. It says the all body suit would sell for approximately $110. Given its experience, Lucky Duck believes the all body suit would have the following manufacturing costs. So this is a situation where they make swimsuits, bodysuits, but then they figured out there's a specific unique one that we can create that's like a niche for us, and we are able to set our own price because it's not out there, right? That type of bodysuit is not out there. So we have to figure out, this is our cost, how much do we add on to our costs in order for us to come up with a price that we will charge to our customers for that bodysuit. Total cost here, direct materials plus direct labor plus manufacturing overhead is $100. What will be the price charged for the all body swimsuit? Assume that they're using cost plus pricing and sets the price based on 25% above the product cost. So very simple, what do you think the price will be? $125, Samin says. Anybody else has another idea or maybe similar or the same? Yeah, same 125, exactly. Part 2 says, under what circumstances might Mighty Duck consider manufacturing the all-body swimsuit given this approach? Look right here, it says the all-body swimsuit would sell for approximately $110. If it's gonna sell for $110 and we have looked at our total cost and we calculated our price that we should charge for it to make sense for us, then it's $125. That is less than, that is a lot. The selling price we can actually charge for people to buy it is $110. It's less than how much we calculated our price to be in part 1. So why would we sell it? What circumstances would we sell it? Okay, so that's a question that we usually have to ask ourselves when we are working with multiple products. So this is what we should consider. Mighty Duck might consider manufacturing the all-body swimsuit is if it has excess capacity. So if we have more space in our manufacturing plant to accommodate it, then we can do that. Okay, because manufacturing the suit will not affect our fixed costs. Okay, with $110, we are able to cover our variable costs. So then if we have extra room in our factory, then why not? We'll create it, okay? As long as we can cover our variable costs, as long as we have a positive contribution margin, then we can. So that's contribution margin is what people use to make decisions in this type of situation, okay? So just remember that when you're making these types of selling decisions, whether we should make it or not, contribution margin is what we use because fixed costs are sunk anyway, right? Fixed costs have already been incurred, they cannot change. The next one is the total cost plus pricing. So Think4 manufactures video camera pens and has the following cost data at budgeted sales volume of 10,000 units. Okay, so we know what the product cost is, direct materials, direct labor, variable manufacturing overhead. Okay, so that will give us our variable manufacturing overhead. So this is part of our product cost. But variable selling and admin, is that part of our product cost? Variable selling and admin, is that part of product cost? Is variable selling and admin part of product cost? No, it's not. So that's a period cost. All right. So our variable cost per unit here, they give us a variable cost per unit of $60. We have our fixed manufacturing overhead per unit of $28 and our fixed selling and admin per unit of $24. Fixed cost per unit together of 52. So 52 fixed cost per unit and 60 variable cost per unit. Thingmore has decided to price its new shop vacuum to earn a 20% return on its investment. So they want to have a 20% return on this $1 million here. So 20% return on the $1 million, so they want a $200,000 return, okay? Total fixed cost per unit is 52. The expected return on investment per unit is $20. So how much will be the expected selling price? It will be our variable cost plus our fixed cost plus the expected return of $132 per unit. Does that make sense to everyone? Total cost plus pricing, we have our total cost and we add on how much we want to be able to make in profits. And that will tell us how much we need to sell for to cover. This 132 needs to cover our desired profit and our total cost. Understood? Okay, so I'm gonna go back. So we know here that our variable cost is $60 and our fixed cost is $52 per unit, okay? And we also know that we want to have a return or a profit of 20% of our investment, and we invested $1 million, they said. So 20% of the $1 million is $200,000. But how much is that in a unit form? That's $20 per unit. So what we need to do is we need to set a price that covers variable cost, 60, fixed cost, 52, and our return on investment per unit of $20. When you add all that up, that means we need to set a price of $132 in order for this investment to make sense. This is what the business is saying. Does that make sense? Better? Okay, perfect. So what this part is saying is that we can also use a percentage markup. So if you know your total unit cost, the question can give you a percentage markup, or you can find it. So your desired return on investment per unit of the $20 divided by your total cost gives you a markup percentage. When we apply this markup percentage to our total unit cost, that will tell us how much we need to mark up the cost by. So our selling price needs to be total unit cost of 112 plus the markup, which is going to be equal to $132. Just another way of doing the same thing. Okay, so chapter 9, 937A, problem 937A. 937A, there it is. Bolus Computer Parts Limited is setting a selling price on a new component it has just designed and developed. The following cost estimates for this new component have been provided by the accounting department for a budgeted volume of 50,000 units. They give us a direct material per unit, direct labor, variable overhead, fixed overhead in total. They give us the variable selling and admin per unit, and they give us fixed selling and admin in total. Bolus Computer Parts Management requests that the total cost per unit be used in the cost plus pricing of products. On this particular product, management also directs that the target price be set to provide a 25% return on investment on invested assets of 1 million. Part A says, calculate the markup percentage and target selling price that will allow Bolus Computer Parts to earn its desired return on investment of 25% on this new component. Remember, we found out before, it says, first part says, calculate the markup percentage. And we've already learned how to calculate our markup percentage. So our markup percentage is right here. Desired return on investment per unit divided by the total unit cost. Okay. So based on that equation, what is your desired return on investment per unit? What is your desired return on investment, knowing that the desired return on investment of 25%, 25% of what? What are we going to multiply the 25% by? 25% times, how much did we invest? We invested, question tells us how much we invested. See where, yep, 1 million, good. So 1 million. So 25% of 1 million gives us how much? 250,000, good. And 250,000 is a total, but they said in the equation, we need desired return on investment per unit. What's the per unit amount? We have to divide that by how much? How many units do we divide that by? 250,000 divided by? The question tells us 50,000 exactly. So that gives us 5, right? So $5 is the desired return on investment per unit, and we have to divide it by the total cost per unit. And our total cost per unit is, okay, I see 135. Any more? Tell me what you came up with for your markup percentage. This is the equation again. What did you come up with for your markup percentage? 3.7%, okay? And then you're going to multiply that by your total cost and then add it back to your total cost, and then that'll tell you how much your selling price will be. So can you drop your selling prices in the chat based on that for me? What do you think the selling price should be? Okay, 140. Somebody says 140. Any more? Nobody else? Okay. Gonna pull it up. Problem 937. Okay. So again, we were able to calculate our $5, right? What we needed to double check is, did we calculate our total cost properly? And I'm pretty sure that's what somebody said in the chat, 135. Direct materials, direct labor, variable overhead, fixed overhead, variable and fixed selling and admin. That is our total cost, right? Just the total cost. Total cost, we multiply that by, we have our total cost and we have to divide our return on investment per unit divided by our total cost gives us our 3.70, very good. And then once we multiply the 3.70% by the total cost and we add that, then we will get our target selling price. Or 135 plus 5 equal 140, same thing. Great. I'm gonna leave part B for you because it's exactly the same, right? But this time it's asking you to assume 40,000 units. So this part B is going to help to make sure you understood what we did in part A. Okay, so what I did here is I just, again, these slides are already on the e-class, but what I did here is I just showed you exactly where you're getting your information for this question. So when you're reviewing it before you can try part B, this might come in handy for you. So you're going to get your total cost per unit from this information here. You're going to get your desired return on investment per unit from this 25% here. And then this gives you a markup percentage. And then you can use this markup percentage to come up with your target selling price per unit. So refer to this when you are working on part B. Okay. Now, cost plus pricing advantages and disadvantages. So for the rest of this lecture, everything here is going to be very theoretical. So I did promise you that I'm going to let you off a bit early. It looks like we only have about 10 minutes before it's 10 o'clock. So I didn't get to let you off as early as I wanted to, but I'm gonna drop the link in the chat for you. You can go over these slides and then you can work on all the theoretical parts of the slides on your own. All right, you're welcome and enjoy the rest of your course. And happy Valentine's Day again. Sucks to be in class on Valentine's Day, but have a very good rest of your semester. You're very welcome, Ciara. You're very welcome. Thank you for coming and showing up and participating so much. Have a good night.